All right, next up we have Rob Da Silva, the head of research for Research IP. We're going to be looking at the role of satellite investments. I think this will be very helpful to help put context around all these bits and pieces that we've been hearing this morning and how to actually pull all that together. Go ahead, Rob.
Thanks very much. So we are here to talk about satellite investments, so the core and satellite approach to investing, which has been very popular and iconic for decades now. And as an example of that, you might recall Lucas Pawad, from Fidelity. His presentation, his second last slide, was a core and satellite picture, where one of the satellites was the contrarian investing strategy that he was talking about. So there you go, it's everywhere. So it's a very useful topic to discuss. And so today I've got two experts in their fields to come and talk with us about that. They're Chad Hitzeman from Global X and David Wanis from Longwave to speak. They'll talk about 7 minutes each on in a presentation format, and then we'll sit down and have a chat and open it to any questions that you might have. So, guys, if I can have you join us, that'd be great. And I think Chad is taking the first crack at it.
Okay, it's wonderful to be here entering 2024 in a mad rush. I'll try to get through this presentation in a mad rush. 7 minutes to discuss portfolio construction is tough, but we will attempt to do it. A bit of biographical background first about our firm. Global X, or global in scope. We have different strategies across income, across commodities as liquid alternatives, such as precious metals, commodities. We also have thematics. So thematics is certainly an interest area for us, and I'll define that hopefully a bit more precisely as we go through the presentation. So that's a bit of scene setting and diving right into it. Satellites, portfolio construction can get very wonkish very quickly. Very technically detailed, so I didn't want to go down that route, especially given the time constraints. Suffice it to say, in simplified form, I think that satellite investing is basically introducing an exposure that tilts the portfolio in terms of reposturing slightly the portfolio mix. Another thing to mention here is it's not just exclusively your equity bucket that you can introduce tilting to. So it's applicable, of course, to fixed income. And furthermore, if you have an alternative sleeve, it can be done there. So a few itemized examples. If you're going to do liquid alternatives, mark-to-market alternatives, perhaps it's in the form of commodities. Or perhaps it's a liquid diversifier like Australian dollar gold. Or if it's on the equity side, it could be a thematic. And just quickly stated and defined, thematics for us, and there's a very surgically precise meaning here, because in all seriousness, a thematic is only a thematic from our mind's eye if it has what's referred to as an adoption curve. So basically, a thematic universe is tailwinded by structural transformation, and that transformation takes place long-term over an adoption curve. And I have a graph that shows that illustrates that a bit later on. The other thing that satellite investing denotes and connotes is sizing. So it's the case that the satellite sits as an addendum to the core position. Another thing that satellite investing denotes and connotes is that it's a pocket in the portfolio wherein perhaps you attempt to achieve outperformance. That is to say, if it's an equity tilt, there's perhaps a bit more aggression in terms of active share. Lastly, diversification. So it's important that the tilt add value, it's additive to your core position and complementing it in terms of kind of a left shoe, right shoe approach, that it's additive in some way, shape, or form, be it on a Sharpe ratio basis or whatever other consideration. As an example of a satellite, I wanted to quickly introduce the concept of thematic investing. and that's certainly an area over which we have a specialization. So that is the adoption curve that I mentioned earlier on. And we think a thematic qualifies as a thematic if it has an adoption curve runway, an S-curve, as shown there. And one thing to mention is that on the right-hand side of that S-curve are more mature thematic equity universes, so social media. And one way to think about those more mature universes is that they're defensive growth. And as a matter of fact, there is such a thing as defensive growth, recent history has shown. And then further down on the left-hand side are higher growth universes, more nascent universes. So think the metaverse, think hydrogen, and so on and so forth. Each of those areas I mentioned, are tailwinded by structural transformation. Think aging of the population, demography is destiny type consideration, or think energy transformation or energy transition, and so on and so forth. So ideally, it's the case that as time goes on, and the slope of that curve is, among other factors, dictated by affordability and accessibility. So as costs go down, adoption goes up. And the thematic universe has to have high impact adoption potential. It can't just be the case that but a part of a consumer population engages commercially with the thematic. It has to be kind of widely used, so think the internet. So that's just a little conceptual framework around thematic investing and how we approach it. The other thing is that, to differentiate between structural themes and cyclical themes, again, just to reiterate and reinforce, ideally we're trying to capture equity universes that have that runway. So thematic universes, specificity of focus on certain companies that are connected to these changes, revenue pure, so there has to be revenue purity to the theme to be true to label, and then hopefully over the long term, it rides the adoption curve, so the orange line rather than the blue cyclical line. And lastly, I just wanted to cap off in terms of best practice from our mind's eye when considering thematic satellite investing is to know back to front the exposure that you're engaging with. So in other words, more or less precisely how you're tilting the portfolio. So understand which stocks are associated with the materialization over time of a given thematic universe. So how deep is it? How liquid is it? And so on and so forth. Another thing is, how concentrated is the portfolio? Is it a 30 stock portfolio, 40 stock portfolio, or perhaps a 100 stock portfolio? The other thing, lastly, that I think is interesting that I'll close on in terms of just reviewing thematics and having a look into them is the way by which they're weighted, the weighting scheme. They could be purist market cap weighted, or perhaps they're equally weighted. If it's equally weighted, it introduces some interesting dynamics, such as you're selling high, buying low, which is best practice, but also it's contrarian in a way. So on the occasion of rebalancing, if it's equal weighted, you're selling the winners, buying the losers. So those are just some best practice considerations when thinking about thematic satellite investing, and I hope that's helped. I look forward to the panel discussion. Thank you.
Thanks, Chad. I'll use these mics here if that's all right. So Longwave specialise in Australian small caps, and so we're going to just zoom right into satellite investing in the Australian market and how active small caps sort of play that role. What we find interesting, this is 33 years of index history, and whilst we're always looking around the world in different asset classes to try and find high returning things to invest in, over 33 years, the Australian market's actually done really well versus MSCI World and emerging markets perhaps more considered a satellite than a core part of a portfolio allocation, but nonetheless, even pre the benefit of franking credits, the local homegrown market has sort of more than held its own. And when we zoom into what happens inside the Australian market, you actually get an interesting picture emerge of core and satellite. If you just looked at, this is again 33 years of history, Now we're including at the far right Morningstar active median fund returns net of fees. But if you just take the first two bars, the indices, it doesn't look like the small cap effect really works in Australia. Having passive small caps as a satellite in your portfolio hardly gives you any benefit. It's lower returning and not shown on that chart. It's more volatile. On the far right-hand side, however, even net of fees, active small cap investing has been quite fruitful. And it's not really about outperforming the small ords, which is the benchmark for most small cap managers, including ourselves. It's actually about, as Chad mentioned, bringing something additional to the overall portfolio. So if your core is Australian equities that we've used the All Ordinaries here to represent, having an active satellite in small caps is about bringing something additional to that portfolio, not just outperforming the benchmark. Interestingly, active large cap managers have had a far tougher time of it. So net of fees, they've basically kept pace with an index, but of course the index is gross of fees. So then the question gets asked about, well, why is that the case? Why is it that active small cap managers are able to generate this alpha? And is it an artifact of history or is it sustainable? Is it something to do with the structure of the market? So I've got a few charts here that try and illustrate just why small cap alpha is available and why small caps are so different to large caps. It's not just that they're smaller businesses, it's a structurally and fundamentally different market dynamic. So just to explain the chart on the left, you might not have seen something like this before, but what we've done is we've taken the Small Ordinaries universe and every 3 years in the teal bars, we've said how much has that universe changed, right? So you can see in many 3-year periods, almost half of the investment universe is new. Because in small caps, that's where new businesses are formed, where new industries come through. In Chad's kind of life cycle and penetration of thematics, they often show up in small companies first, right? So it's a very dynamic part of the market, and that's been quite consistent over many years. If we look at the grey bars there, that's the large cap index, the ASX 100. It's a far more static, stable universe. The big four banks, BHP, Woolworths, Telstra, they've all been mainstays of that index for a long time. Now, that's not to say it hasn't delivered the returns we saw before, but it's just a very different market dynamic. The second thing that helps active managers in small caps deliver that return is just how much competition there is for ideas. Now, you've probably, again, seen a version of this chart before. A lot of people will show you sell-side coverage of small caps versus large caps and show you how they're undercovered versus their large cap brethren. What we're looking at here is the buy side, fund managers. How many highly motivated, professional, highly paid investment managers are there scrubbing down each one of these ideas? And so if you think about the numbers, there's about 150 active large cap managers in Australia doing Australian equities. Those teams are anywhere from 6 to 12 people. And so we're talking north of 1,000 analysts in the buy side investment community trying to find an edge in large caps. And by and large, they're restricted to about 125, 150 stocks. So the number of analysts per investment idea in large caps is almost 10 per stock. In small caps, there's about 50 managers. They have about 3 to 4 people in each manager, and they're looking at a universe of 1,000 opportunities. So actually, if you looked at 3 or 4 small cap managers side by side and you looked at their portfolios, in many cases, they're completely different. They're finding ideas in very different parts of the market. And so they're the reasons why we think this is a structural difference and that the alpha that active small cap managers can generate should be sustainable. The last slide here then looks at fees. It's interesting to note just how cheap core exposures have become, and that I think is fantastic in terms of the benefits that provides investors to get market exposure for single-digit basis points. That's not quite the case in passive small cap, and the active small cap fee is quite a bit higher. As we saw earlier, you're probably getting a benefit from that in terms of the returns you're generating. Now, being a managed account conference, obviously the uncapped ICRs and the performance fees in a lot of small cap funds can be problematic, but that's not all the funds in the market. So just to sort of put our own fee structure out there so you can understand how we sort of have tried to solve that problem, we have a fixed base fee only model in our small cap fund, no performance fee to make sure that ICR is stable. And as the funds under management grow in our A-class unit trust, that fee will come down. And so ultimately what we're trying to do is democratise the access to that active small cap alpha and remove that fee hurdle that occurs in a lot of small cap funds. So that's it from me. Let's perhaps jump into the panel discussion.
Okay, so great timing, by the way, guys. Beautifully done. Let me put a perspective on thinking about multi-asset portfolios in this framework. You've got a whole bunch of building blocks to work with different risks, different costs, different attributes. And at a big picture level, you've got a fee budget and a risk budget. And you want to find the best possible way to blend all of that into a mix that works optimally for your clients. And so, fees matter, active versus passive matters, diversification matters, as you've mentioned before. Maybe you could comment, both of you, on how you see those features working with, your particular products and what your thoughts are on that.
Sure. I'll lead off, I guess. So to your point, Rob, it's about mixing. But the weightings, of course, the core position, as the name suggests, core satellite has a heavier weighting in the portfolio. So the satellite just opens up the scope to take on different attributes, performance properties, and so forth. So for instance, a simple couplet strategy to think about on a simplified portfolio basis, maybe a 60-40 portfolio, is to open up an alternative sleeve. You can perhaps, instead of having illiquid alternatives, and I don't think it's an oxymoron to say that you can have a liquid alternative. I think the primary property of an alt is non-correlation, but you can match with your risk-on exposure something like a gold exposure, which has persistently, historically been negatively correlated, as a matter of fact, more to Australian equities than international equities. So just matching and marrying. And so when equities zig, gold tends to zag in terms of that hedging capability. But that would be a quick commentary on the question.
Great.
My only point, I guess, is that the pricing of core assets has come down a lot, and that's not just Australian equities, it's across the board, and I think that's terrific in terms of being able to build portfolios. And I think it also highlights there are some asset classes where alpha is available and it's worth being active, and others where it's just really competitive and really hard to outperform. And so, the scope to think about where the fee budget is, where the alpha is available, that's changed a lot in the last 25 years. And so it really enables everyone to build, I think, more sensible portfolios and use the fee and risk budget sensibly in that way.
I should say you can also have different aims that you're attempting to achieve. So of course you're trying to maximize total return, but of the total return, perhaps maybe you have a tilt toward income. And on market today in Australia, which is fantastic, a variety of ETF providers, active managers, and so on and so forth, over their equities, they might have an option strategy, and then thereby harvest premiums to generate that income. So you can also think about the tilt or the satellite as serving that purpose, the income.
Yes, that's a good point. Actually, just on your point, David, there are some asset classes. I mean, even the Spiva report, which is notoriously used to promote passive products because 95% of active managers underperform. Not a statement I believe in, but that's sort of the mantra that's said. But even they admit that small cap managers can and do outperform, and they've statistically proven that multiple times. I think there are other asset classes where that can happen as well. And so it comes back to your point about using active in the satellites perhaps more judiciously than in the core. I think part of it is also that point you made about the coverage aspect of how many analysts are actually looking at that market. And I think that's true for other markets where you could make the case that there's alpha opportunities. It's like how many people are actually looking at this market day by day and focusing on, extracting alpha from it. The more you have, the less alpha, you potentially can get. So that's not a question; it's a statement. But Chad, gold, is it core or satellite?
You know, I had a conversation with someone just earlier. Perhaps one person's core is another individual satellite, but for us, for Global X, for over 20 years now, as a matter of fact, we pioneered a physically backed gold exchange traded fund, and for 20 years we built a business on that, and we've been acquired by Global X and so on and so forth. So I think there's some validity to say that gold has staying power. Again, it historically, persistently has shown diversification effects toward equities. So again, if you match and marry and couple those two together, it's an interesting, unique combination. And furthermore, you achieve that alternative performance property you've introduced by way of gold without undercutting liquidity of the portfolio, which is unique.
Dare I ask you the follow-up question of Bitcoin as digital gold? Will it ever replace gold in exactly the way you're talking about? Because some people promote it as that kind of asset.
Sure. I think, and I would love to hear what you have to say too, David. I think Bitcoin, if I may just pontificate and give my 1 cent, 2 cent input, is that it's something of an ambiguous asset.
Yeah.
It has a pretension to being an asset and finding a use case. But just in short summary, what I would say, if it had a pretension to replacing gold, I think that volatility profile of Bitcoin has to come down a bit.
Yeah.
Gold's volatility profile is comparable to equities, whereas Bitcoin's is magnitudes larger than both.
Yeah, that's a good point.
Yeah, I think we had an IMAP panel actually in late 2021 on Bitcoin and crypto assets when enthusiasm was pretty high. And one of the concerns we had at the time was we don't know how it's going to perform in the environment where you need the diversification to work. And so then what we saw was risk assets sold off and Bitcoin sold off even more. And so it kind of undermined the theory of what it was supposed to do in a portfolio. So, we don't have a strong view. We don't trade in those sort of assets. But, the test of an asset's role in a portfolio is really for it to deliver the diversification you're hoping for when other things aren't working. And in that case, it didn't.
It does have high octane performance if you want to step into that violent volatility. And to be honest, some investors make decisions in econ, in a 200-level econ course, you're introduced to the concept of utility curves. And you find that decisions are based on preferences. And some investors have appetite for that risk, as a matter of fact.
Yeah.
So.
Yeah. Touching on the point of diversification, as I mentioned, the building blocks, one important aspect of the core versus satellite approach, if you're in a satellite, if you've got satellites you're choosing and they're a little more expensive and you're hoping for more alpha out of them, et cetera, one of the things that you want is that they're not correlated to the core, because there's not much diversification benefit you can get out of that. So guys, can you give some perspective on that concept and then tie it also into, because it's relevant, position sizing? How much do you put in a satellite option, and to what extent does it become a big feature of the overall sort of portfolio?
So I might start with that one, because in the case of Aussie small caps, you're not getting diversification. The correlation to the equity market is very high. Yeah. It's simply acknowledging that there are sources of equity growth return in Australia outside large caps. And so what often happens is people will put the indices into a mean variance optimizer, and because of the lower return of the index and the higher volatility, it will solve for have no small caps, right? So you need to think through a little bit, are you investing in the index or are you investing in active? But its role is not to diversify. Its role is really return seeking and getting that uplift in the growth return. So you need to be very clear about what it's doing in the portfolio.
Yeah.
It's such a great question about the weighting. I guess it's per risk profile. I've seen a range of basically satellite tilts between 5 to 10%, but as a matter of fact, I've seen it upwards of 20%. But perhaps that's more applicable to a higher risk profile. And also, to our mind's eye, it should lead to diversification, but sometimes, as a matter of fact, perhaps tilting is doubling down. Maybe you want to double down on a risk-on position. So there's some fluidity to these terms and concepts, as a matter of fact.
Yeah, Yeah. And you touched on another important point, which was income, because that's part of the equation in satellite options as well, because they may be less liquid, or they may be specifically targeting income rather than capital as part of the contribution to the overall objective. So have you got any perspectives on that?
Not really from my perspective. I mean, small caps are hardly ever used for an
No.
income perspective.
Yeah.
It's more for the growth sleeve.
Yeah.
And it's also depending on the problem you're solving. So a lot of income funds are harvesting franking credits for the benefit of retirees because of their tax position.
Yeah.
And that's a very equity kind of heavy position. When you're stepping into a multi-asset portfolio, you have other income generating asset classes. And so the role of equity can actually move to a different part of the portfolio in that perspective.
We've only got oh, sorry, go on.
Sure. No, I would just say what's really great to see in Australia is that from active providers, and I can name drop great names on the active side and on the passive side, our peers as well. Not only are there dividend-focused strategies, but there are option writing strategies. And I think that's a fairly new addition to the stable choice that investors have here, which is great. So you can try to dial up the income generation from your portfolio by way of that.
Yeah. So we've only got a few minutes left, but we do want some questions from the audience. So if you feel like playing hard quiz, ask the hardest questions you possibly can, because we've got
Don't do that.
we've got good people to do it.
Okay. Just probably two questions. I guess the first one for David. You put up some charts for a 33-year period. It's a long time. And over that time, I guess the structure of those markets would have changed a lot. And I guess the themes, economic themes, would have changed a lot as well. Have you got a view about, maybe more specifically about small caps, but have you got a view about the outlook for small caps here, for example, elsewhere, now that we're through the commodity boom and we're in a tech world?
So the reason we use such a long period of data is because we tried to get as much history as possible to cycle through all of these cyclical performance periods. And so if you look at small caps at the moment, we've been through one of the worst periods of underperformance versus large caps in that 33-year period, right? So we can show you the last 4 or 5 years, and you'd say, even with an active manager, why would you bother owning small caps? And then we could zoom out a bit more and show you 15 years and go, oh, actually, they're okay again. So the idea is to kind of go, what's the long-term sort of performance? What's the benefit of being there structurally? And then if you look cyclically, yes, we've had this period of underperformance. We came in that late 2021 period, there was a lot of enthusiasm. We'd moved well beyond being a mining-driven small cap market, and it was all about tech and innovation and Bitcoin and crypto. And a lot of that drove the market up, and a lot of that ended up, when it blew up, driving the market down. So sitting here today, it feels like a lot of the enthusiasm is out of the small cap market. The assets are cheap. A lot of allocation away from small caps happened kind of 12, 18, 24 months ago. And we're starting to see institutions allocate back into small caps. That was sort of a story of the second half of last year. And we're seeing more retail interest starting to allocate back into small caps this year. We don't try and pick those cycles. Our view is having a long-term quality investment process means that you don't suffer as violent a sort of drawdown ride. But that's the more recent experience that we've seen.
And in terms of, say, for example, if you look at Australian small cap portfolio versus US small cap, what kind of differences do you feel are important to note looking forward?
That's a great question.
Yeah, so there's clear sector differences across, and tech is one of the big ones. Even though tech has become a bigger part of our index, it's still now only 5 or 6%. Some of our big tech winners have gone up into the top 100. Think WiseTech, Technology One, Xero, etc. But the other similarity between Australia and the US is both the Russell 2000 and the Small Ords have a lot of what we would call junk companies in them, right? A lot of terrible businesses that really half the job of an active manager is ensuring they don't get in the portfolio. So you see the same benefits of active management there in avoiding a lot of those kind of junkier companies.
Just out of curiosity, can you comment on what constitutes a small cap in Australia versus America, because it's like a small cap in America is like 10 times the size of one in a market cap sense.
Yeah, I'm not as close to what the cut-offs are. They are
Yeah.
bigger, but yeah, small cap there would probably go up to, I don't know, 10, 20 billion. Is that?
Yeah,
you have-
yeah.
you on that? But I'm
So,
not.
so there's a significant difference in the market cap of the businesses, and therefore kind of, to a certain extent, the maturity of them and where they are in that sort of S-curve. Other questions?
I categorize my question as a simple one rather than a hard one.
That's all right. They're allowed.
We come here and we hear a lot of the presentations and the complexities of what goes on in fund managing, etc. I'm just wondering whether, in the end, you guys are conscious and are judged and not manipulate, that would be the wrong word, but act on the basis of the returns that you generate, because the end user may not be conscious of all the complexities that you're going through in trying to put out that return. And so how much emphasis do you give to the return that you generate as against the complexities of generating that return?
I mean, ultimately, it's about the return, right? Us making our business and our decision-making process overly complex and saying, you need to pay us a high fee because we're doing really hard things, but we're doing really hard things that don't end up in outperformance against a passive benchmark. Like, what's the value in doing that? So ultimately, we care about, and we think our investors care about, the net returns through time. We also think they care about the journey, right? So that it's not plus 100%, then minus 50, then plus 150. And so it's aligning what we're trying to do with their long-term investment goals, but we have to deliver. We don't get paid to do clever things if it doesn't work and outperform. And as you saw from our fee structure, we also have a philosophical view on what a fair fee is versus what the norms are in the market. And in our case, it's lower.
I'm
I
going
think
to
that's
cut it there.
Yes, that's fine. We're getting pulled off stage, so can I thank our